Since 2021, Intel stock is down 63%. The entire narrative around Intel has absolutely gone terrible. We've been following Intel. We liked it for a long time. We still do like it. But again, don't buy anything because we are buying it. Never buy anything because somebody else is buying it. Understand what we're trying to do here. We're trying to teach a process. We're trying to teach a way that you can understand why you should buy a company. Because if you don't understand why you're going to buy it, if the stock falls, you're going to panic and you're going to sell prematurely. Now, Intel has a couple of major pieces of news. One, NVIDIA's CEO just came out and said they're testing Intel chips and the results are very good. Two, there's a lot of work being done in cloud computing for Intel. Three, they have a $20 billion factory being built in Columbus, Ohio, just down the street from us, that's going very well and will be the largest manufacturing plant for chips in the US. The chip market is growing like crazy. Intel, I think, will still benefit from that, but there's a lot of negativity around Intel because of AMD and how great their processor is. So the question is the risk on Intel worth the whole entire idea of buying into it? So in this video, stick around for it because we're going to go over several things, including the fundamentals, including a price to pay for Intel. I don't care what level of investor you are. If you're a brand new beginner, we're going to start more basic. I'm going to explain things in a basic way. And as we go along in the video, it'll get more and more intricate and more detailed. So please hang on. Let's go take a look at Intel right now. All right, guys. So for Intel, a major bull cases, they are probably the most recognizable brand of chip. Yes, AMD has been nipping at their heels, but when you see Intel chip inside, it's a very powerful thing still. Does that mean it's going to continue forever? Not necessarily. Remember, BlackBerry 15 years ago was the smartphone, and then iPhone started to gain it, and now BlackBerry is a thing of the past. I'm not saying Intel will become BlackBerry. However, Intel still has that great brand name and brand awareness. Now, two bear cases. One, Tesla's announced they're not going to be using Intel's chips in its cars. Fine. That is a bad thing. Tesla's a fast-growing company. They're probably going to sell 1.4 million cars this year and growing. And two, they have a foundry they're building. That's the one they're doing here. Their margins are going to be lower than other foundries around the world. Why? Obviously, we have higher labor costs here. One of the benefits of being a wealthy country is people make a ton of money here. So when they make a lot of money, margins are going to be lower for these chip manufacturers. But it was really important for Intel and the US to get these plants built here in the US to start building chips here. We didn't want to be subjected to everybody else overseas and their kind of issues. So they're building it here, but that's going to lead to less margin overall. So let's pull up Intel in our software. Now, guys, Intel's market cap's $136 billion. 136. They did revenue last year of $56 billion. Let's go to NVIDIA real quick. Almost $1 trillion with $25 billion in revenue. 7 times the market cap. Now, obviously NVIDIA has a lot more growth potential in terms of revenue, but are you overpaying for that? And are you underpaying for Intel? That's the question. They're only selling for 2.4 times sales. NVIDIA is selling for like 40 times sales. Big difference. They lost $2.8 billion last year. NVIDIA did not. But the 5-year PE is 8 with a 5-year profit margin of 23%. That's a big profit margin, even with the last year being a negative. All right. Gross profit of 38%. I think before they started having their losses, they were in the 45% range or so. Return on invested capital, even with poor performance lately, not bad. 9.6%. Actually kind of surprising here. All right. Now, let's take a look at this income for Intel and why it's down so much. This is no bueno. 60 billion, 64, 70, 75, 77, 77, 56. Everyone saw a drop in revenue, but for a company like Intel, that's a big drop, guys. That's almost 30% drop. That's a 25 to 27% drop in revenue. Go to their net income. 11, 20, 22, 19, 24, loss of 3. So, are they going to get back to here or somewhere in between? I don't know. But the last time they were at this level of $56 billion in revenue, they made $11.5 billion and $11.8 billion. So this is clearly an anomaly right here. Well, I shouldn't say it's clearly an anomaly. It's obvious that if they can get back to where they were before in terms of their margins, clearly it's a cheap company right now. Because at $11 billion with a $135 billion market cap, that's a 12 times earnings. And if they just grow with the rest of the world, that's a pretty good return on its investment. Now, What's Intel doing? They've bought back a few of their shares, but they've also increased in the last couple of years. I don't know why a company with cheap stock is issuing shares, but that's always a red flag for me. But let's go look at the 8 pillars here. All right, 8 pillars. Obvious, obvious, and obvious. Their cash flow has just plummeted. Their revenue has plummeted. Their net income has plummeted. It is bad. Like I said before, this is absolutely a turnaround play. This is not for those people who want to buy a great company at a great, it could be a great company at a great price, but this is absolutely a turnaround play. If they can get back to their $20 billion a year in profit, this is a no-brainer. That's the question. Can they get back there? The news out there is all about AMD, NVIDIA. Intel's dead. And I've heard this before. I've heard it before about other companies. The question is this true? They still have a great brand name. We got to remember that. Let's actually look at AMD real quick in terms of their market cap. AMD's market cap is higher than Intel's by a lot. And again, revenue is a lot lower. So $205 billion market cap with a lot less revenue. Okay. All right, let's go see what the analysts are saying about AMD. About Intel, sorry. They're expected to make 53 cents per share this year, getting up to $4.24 in the next 4 or 5 years. $4.24 times 15 multiple is roughly $63 a share. All right, that's a doubling up here if they are able to do this. That's why I talk about a turnaround play. Is this enough? Look at their revenue growth potential. They're expected to do $51 billion this year, getting back up to $85 billion here in the next 4 years. Double-digit growth right here, as you can see. Guys, that's big money. They can get to new record highs if this occurs. I remember reading somewhere that the chip market has a potential growth rate of 12% a year for the next 10 years. You better believe Intel's going to be on the receiving end of that. Even if, because guess what? Even if they're not the biggest player getting the biggest growth, they're still going to grow from it. Especially if they have their own foundry. It gets them go control their demand, control their supply. They can build a lot faster for themselves. And that'll help them regain market share. All right, so what's a reasonable price to pay for Intel? We're going to hear the stock analyzer tool. So before we go into this, you've seen a lot of our software. You haven't even seen all the tools here. There's all these other tools here that are available in our community of thousands of people, because being an investor can be a very lonely road. You only have yourself to talk to a lot of times. Your friends don't get it. That's why you have thousands of people in here who all talk, and there are conversations there about Intel. You can go in the community, type in INTC, and it'll take you right to the conversations about Intel. All of this, everythingmoney.com, $1 per day for 7 days is our great trial, and it's a little over $1 a day once you go permanent. So check it out, everythingmoney.com. You get all of this and the community. So let's do our stock analyzer tool. This tool was used 1.3 million times by our users in 2022, and it's only growing. So let's go make our assumptions on Intel for 10 years. Now, I'm going to go for quite a wide range here, because that's our goal here, to come up with low, middle, and high numbers. I'm going to go with 3, 5, 6, and 9%. Okay, 9% growth is a lot, but it's lower than the 12% expected growth of the industry. And if they're able to reinvigorate their process, they could be a big benefactor of the growing chip industry. But that's my highest assumption here. I'm not making it my reasonable assumption. Okay, profit margin. I'm gonna assume they get back to normal levels, but it's probably gonna take some time. So I'm gonna go 16, 21, and 26%. Because if they're able to grow at 9%, even though their foundry would have lower margins, I gotta think they can really drive that profit margin up. And this profit margin has been driven down by the last year of a negative profit margin. So I have to factor that in here. Free cash flow margin, ooh, it's been ugly. I'm gonna match exactly the profit margin, because over long periods of time, free cash flow and profit margin should equate out, okay? It is kind of concerning to me that their free cash flow is lower than their profit margin, but we'll see how that affects things. And that's something to consider when doing your desired return here. Now for PE, I'm gonna go with 13, 16, and 19. Because if they get this high 9%, they're probably ROIC and their moat will be pretty high, so I'm willing to pay a premium for that. If they get the 6%, they're probably stable company, all good and great. 16 is about the historical average. I'm fine with that. Now for desired return, the more conservative I make my returns, the less make my assumptions, the less return I need, the less margin of safety. As my assumptions go higher, I need a higher margin of safety, which means a higher return. The more return I want, the less price I pay. Since Intel still has some issues, I'm going to go with 11. I'm going to go with 12, 14, and 16%. I still want to make some money for it being a turnaround play. Hit the analyze button. All right. A low price of 25, a high price of 60, a middle price of 40. So if you believe this middle case and you do your research and you believe it wholeheartedly, you should be buying the company at 40 bucks. If you pay today's price and these assumptions occur, you'll make 8% return based on a net present value, 17% return if the middle price happens, the middle assumptions happen, and 25% return if they're able to knock it out of the park over a 10-year period. Those are huge returns. But again, you've got to believe the story. You've got to believe it, and you have to be ready for a lot of volatility. I have a hard time believing that if the NASDAQ falls hard, they won't fall with it. So guys, if you like this, again, everythingmoney.com, $1 per day for 7 days. Check it out. The software is awesome. Thank you very much for watching.